An introduction to Fibonacci patterns. Hello, and welcome to this overview of Fibonacci patterns. The Fibonacci ratio was named after an Italian mathematician who published the sequence of numbers that approximated this ratio. It was later also called the golden ratio because it appears all over nature: seashells, pine cones, the way flower petals and tree branches are arranged. The list is almost without end. In 1955, George Kelly conducted some experiments in which it was shown that people do not have equally weighted positive and negative outlooks, as one would expect, but rather it is weighted about 62% positive and 38% negative, fitting with the Fibonacci ratio. One could argue that this is one of the reasons why traders seem to behave in a way that often creates certain patterns on price graphs, where upswings and downswings in price match the Fibonacci ratio, or some closely related derivatives of the ratio. If you're interested to know more, there is an absolute mountain of information on the Fibonacci ratio on the internet. For this discussion, however, I will focus less on the mathematics behind it and more on the application of it in your trading. Autochartist identifies 6 different classes of Fibonacci patterns. The simplest 2 types of patterns are retracements and extensions. These both have 3 turning points, that is, where price graphs make highs or lows. Let's look at an example. First, the extension. The 3 points of the extension marked A, B, and C form a shorter line followed by a longer line. Looking purely at the price difference between A and B and relating that to the price difference between C and B, if these 2 lengths are in a Fibonacci proportion, and then we classify it as an extension. Retracements are the same, except that we mark the points as BCD, and they have the large price difference first, followed by the smaller price difference. The expectation that follows is that price could find support at one of the illustrated Fibonacci levels. If this has been a bullish pattern, the expectation would be that resistance will be encountered at the Fibonacci levels. The crux of this kind of analysis is that Fibonacci levels give us a potential preview of where we may encounter support or resistance after the latest turnaround in price. Now, the Fibonacci patterns can become longer and more intricate. If we have a retracement followed by an extension, it effectively forms a 4-point pattern, known as an ABCD pattern. The more points the patterns have, the more significant they become, but the expectations are always the same. We expect to find support resistance at one of the next set of Fibonacci ratios on the price scale. There are also 5-point Fibonacci patterns. The Gartley pattern is an ABCD that is preceded by a point marked as X, which is in a Fibonacci ratio to the whole of the ABCD. The butterfly got its name because it looks like 2 connected triangles, the wings of a butterfly. It also contains an ABCD pattern, but the important ratios are XAAD as well as ABBC. It is worth mentioning that we have emerging Fibonacci patterns, just as we have emerging chart patterns, and there is a separate video in our education section that will elaborate more on this topic. But in effect, every retracement is an emerging ABCD pattern, and many emerging ABCD patterns can also be emerging Gartley or butterfly patterns. That is because the higher order Fibonacci patterns are constructed out of smaller patterns. Every 5-point pattern contains a 4-point ABCD, and every ABCD contains a retracement and extension. With emerging Fibonacci patterns, we illustrate a pink dot. This is the sentence you have to play in your head when you are looking at an emerging Fibonacci pattern. If price reaches the level of the pink dot and it turns around at that level, then expect support resistance at the illustrated Fibonacci levels. So there are quite a lot of conditions that have to be met for an emerging Fibonacci pattern to complete. As you can imagine, it never happens that a pure Fibonacci ratio is encountered due to the discrete nature of prices. So in our calculations, we have a very small error margin that we look at, and when the price ratios fall within this margin, close enough to the true Fibonacci ratio, we approve it as a Fibonacci ratio. There's a whole lot more to trading than simply following green up arrows or red down arrows. The aim of Autochartist is not to be an easy trading system, but if you understand what the patterns mean, then it is going to save you an incredible amount of time and make you many times more productive in your trading efforts. Use these trade opportunities together with your own wisdom and intuition, and use other market opinions and analysis types to form smart and well thought through trading strategies.